Good day and welcome to the earnings conference call of Dalmia Bharat Limited for the quarter and year ended 31st March 2023. Please note that this conference call will be for 60 minutes, and for the duration of this conference call, all participant lines will be in the listen-only mode. This conference call is being recorded and the transcript may be put on the website of the company. After the management discussion, there is an opportunity for you to ask questions. Should anyone need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Before I hand over the conference to the management, I would like to remind you that certain statements made during the course of this call may not be based on historical information or facts and may be forward-looking statements. These statements are based on the expectations and projections and may involve a number of risks and uncertainties such that the actual outcome may differ materially from those suggested by such statements. On the call, we have with us Mr. Puneet Dalmia, Managing Director, Dalmia Bharat Limited, Mr. Mahendra Singhi, Managing Director and CEO, Dalmia Cement Bharat Limited, Mr. Dharmendra Tuteja, CFO, Dalmia Bharat Limited, Mr. Rajiv Bansal, President and Chief Transformation Officer, and the other management of the company. I would now like to hand the conference over to Ms. Aditi Mittal, Head Investor Relations. Thank you, and over to you, ma'am.
Thank you, Fazil. Good afternoon, everybody. We welcome you to the Q4FY23 and FY23 earnings call of Dalmia Bharat Limited. Hope you've had a chance to go through our results which have been uploaded on the stock exchange. Without much delay, I'll hand over the call to Mr. Dalmia for his opening comments. Thank you.
Good afternoon, everyone. And thank you, Aditi, for your opening remarks. It gives me immense pleasure to welcome all of you to the Q4 FY23 and FY23 earnings call of Dalmia Bharat Limited. Let me briefly share my outlook with you, and after which Mr. Singhi and Dharmendra will give you more details about our performance. I continue to have deep conviction on the Indian growth story and would reiterate that the next 2 or 3 decades really belong to our country, with GDP growth expected at 6.5% to 7% in FY24 and beyond. I think that for India to leverage this opportunity that lies ahead of it, and for the government to generate employment opportunities for millions of people who are getting added to the workforce every year, the thrust on infrastructure development, increased public spending, and augmentation of private capex is imminent, and cement sector would be a direct beneficiary of this. I strongly believe that Dalmia's growth will continue to accelerate as India accelerates. From the end of financial year 22, we have increased our capacity by almost 15% from 35.9 million tons to 41.1 million tons per annum at present. Let me give you an update on the acquisition side of cement assets on Jaiprakash Associates Limited. Yesterday, we have signed a definitive agreement for the 2.2 million ton cement capacity at Bhilai, along with 3.3 million tons of clinker, including both at Babupur and JP Super. For the Nigri cement capacity of 2 million tons, we are proposing to enter into a long-term lease agreement having a term of 7 years, with an option to purchase the Nigri unit any time within the lease period for an enterprise value of rupees 250 crores. I'm very excited that this acquisition is coming at a time when India is at the cusp of a strong cement demand upcycle, starting with the pre-election year 2024, when the industry demand is likely to grow at almost 8 to 9%. In April 21, when we had announced the capacity expansion plan and the first milestone of 49 million tons, we were not aware of the opportunity of JP acquisition. Now, with the JP acquisition being signed, it was important to reassess and recalibrate the original expansion plan of 49 million tons. Accordingly, we have decided to defer the 2.5 million ton grinding unit expansion in Bihar. Due to this, the original capacity of the organic expansion changes to 46.6 million tons, and the total capacity including JP acquisition changes to 56 million tons by end of financial year 24. Even if you look at the year gone by, the industry cement demand is believed to have grown at 9 to 10%, alongside an increase in prices on a pan-India basis. As Dalmia Bharat is marching towards its vision to become a 110 to 130 million ton company by FY31, execution excellence and financial performance are the two equal priorities of the company. During financial year 23, we have delivered an industry-leading volume growth of 15.9% YOY, and our revenue for full year has grown by 20% YOY to rupees 13,550 crore. Through significant improvement in multiple operating metrics, such as increase in CC ratio from 1.63 in FY22 to 1.71 in financial year 23, or improvement in renewable energy consumption from 10% in FY22 to 21% in FY23. I'm proud to say that our teams have not only been able to mitigate the adverse impact of the inflation in the commodity prices, but also been able to build on the sustainability quotient of our operations. On a full year basis, the carbon footprint of our company has further come down from 489 kg per ton of CO2 to 463 kg per ton of CO2. Our organization is deeply committed to all our environment-related commitments under ESG, whether it's RE100, EP100, and EV100 by 2030, carbon negative by 2040. And these commitments are an integral part of my personal priorities too, to deliver upon in a timely manner. For the next year, FY24, some of our areas of focus for our company will be: 1. Timely completion of the ongoing capex and integration of the JP Cement asset. 2. Further improve our manufacturing KPIs and build long-term input security. 3. HR transformation with focus on leadership development. 4. Digital enablement of the company. To add to the strength of our leadership and assist in driving the company in the next stage of its growth, I would like to share with you that we have appointed a Chief Operating Officer in our company, Mr. Sameer Nagpal. Sameer has already been with the Dalmia Bharat Group as the CEO of Dalmia Refractory, and he was instrumental in growing the business bottoms up and finally led the M&A transaction in which the refractory business was sold to RHI Magnesita. Mr. Singhi will mentor Sameer in his new role, and I'm excited about having him aboard. With this, I would now like to hand over the call to Mr. Singhi for his opening remarks.
Thanks, Puniji. Happy afternoon, friends. Last year has indeed been a tough year comparatively, as the industry continued to witness unprecedented rise in commodity pricing and particularly fuel. But as Puniji has mentioned, that we are very optimistic about the year ahead of us now and believe that the peak of cost is behind us. Besides the softness in the commodity prices, we are also witnessing a strong demand momentum. During financial year 23, we delivered a volume and revenue growth of 15.9% at a volume of 25.7 million tons and 20% YOY at rupees 13,540 crores respectively. This growth of 15.9% is maybe more than 1.5 times of all India demand growth. The growth is balanced with our regions, East, Northeast, West and South, and delivering a double-digit volume growth during the year. For the quarter, we had the highest ever sales volume and absolute revenue in any quarter with volume of 7.4 million tons and revenue at 3,912 crores respectively. During the year, the NSR growth has been almost 4%, which was led by stability and strengthening of prices in the east and northeast states. While the increase in NSR at 4% been higher than the long-term average price increase of 1.5 to 2% annually, it has not been sufficient to offset the adverse impact of input price inflation. During the year, the average fuel consumption prices spiked from equivalent petcoke price of $141 in FY22 to $198 per ton in FY23, which was again a massive 40% inflation in fuel cost. However, the good part is this inflation has started now subsidizing, with the peak being $218 and now at $174 in Q4. The good news is now spot prices of petcoke are around $140 per ton, which can be effectively used in second quarter. On a QOQ basis, prices marginally softened in southern regions but remained stable in east, northeast and west. During the quarter, our variable cost was slightly impacted due to consumption of high-cost opening inventory of clinker and cement. In Q3 FY23, we had built up clinker inventory due to the upcoming plant shutdowns and debottlenecking projects in ensuing Q4. Thus, while you may see a variation on quarter-to-quarter basis, but you will notice that during the full year, there is not much variation at the overall inventory level. Even in the past, we have seen that companies undertake inventory planning. This is number of factors such as seasonality, plant shutdowns, repair work, new plant line, etc., which may lead to quarterly variation, but on full year basis, it tends to normalize. Our EBITDA per ton during the full year has been 900 rupees a ton, and our exit EBITDA came in better in Q4 at rupees 951 per ton. Like Punitji was mentioning, our people have been very proactive, and as a team, we were successfully able to improve a lot of our manufacturing and sales KPIs, which enabled us to mitigate the adverse impact of the inflation. Mentioning some of these during the year, our blending ratio improved to 84% from 79% in FY22. In Q4, we were able to take it to an all-time high of 88%, with all regions showing progress. And this high blended cement number would definitely further improve in quarters and years to come. Our renewable energy capacity has increased from 17 megawatts in FY19 to now 166 megawatts by FY23 end, which is almost 10 times increase in the last 4 years. During the upcoming year FY24, we are targeting to almost double the current renewable power capacity from 166 to around 324 megawatts. Our sale of premium products has also improved significantly by 19% to 3.4 million tons during full year FY23. As has been our commitment, we have been working on sustainability and reducing carbon footprints month-to-month basis, and I'm very happy to again reiterate that our carbon footprint of 463 kg per ton is one of the lowest in global cement world. I would also like to highlight that 4 years back, we had targeted that our carbon footprint in FY23 would be 480 kg per ton, which our team has been able to improve to 463 kg. Moving on the regional performance, if we look at regional volumes for our company, both in south and east markets, we outperformed and delivered double-digit sales volume growth. The performance in South is especially encouraging, where over the last couple of years, we have continued to strengthen our market share without adding any capacity in the region. Another best part has been that in South also, we have been able to further enhance the blended cement volume, which would further help us in building up more blended cement volume in the years to come. At the same time, our confidence in the East market potential remains intact. This is all the capacity announcements. We believe that the bulk of it has already been commercialized, and now from 23 to FY26, the rate of increase in capacity may drop to 4 or 5% of CAGR, with demand expected to outstrip it at 9 to 10% CAGR growth. This will lead to steady improvement in the utilization levels going ahead, and we could expect a much stable pricing scenario on back of this. And this would prove that our strategy for East has been right. For Dalmia, East is one of the most efficient areas in terms of costs, and we are able to sell 100% low carbon blended cement in this region. On the expansion side, while Shri Dharmendra will give you the detailed update on capex and cash outflow, I would like to update that during the year FY23, we have commercialized 2.7 million ton capacity in both Northeast region respectively. This has taken our closing cement capacity to 38.6 million ton. Recently, in current month of April 23, we have commercialized the new cement line at Bokaro of 2.5 million ton, which takes our capacity of installed capacity to 41.1 million ton. Another good part is that now Bokaro is one of the biggest cement grinding capacity in the country. During the year, our clinker capacity has also increased from 18.9 million ton to 21.7 million ton by March 23. Now during FY24, we have another 2 million ton clinker expansion to come up, in addition to what would come along with JP assets in central region. Friends, I'm happy to share that in Morley, this is the detailed exploration carried out by our teams, as well as revalidation of certain mining leases. We have been able to build limestone visibility of 18 to 20 years. In times to come, it would further go up. During March 23, our capacity utilization of the plant was around 52%, and in the month of March, we have clocked 60% capacity utilization, and we are reasonably confident that during the current fiscal, we should be able to reach more than 60% capacity utilization. On the cost side, we have also taken many initiatives, such as commissioning of WHRS of 7 megawatt, solar capacity of 4.5 megawatts, which will give us full year benefit from this year onwards. As well, reviving the coal linkage will also help. Likewise, in Kalyanpur, which was the acquisition prior to Morley, and the plant which was closed for a long time, the plant has successfully been turned around, and it is now one of the highest profit-making plants in our eastern operations. In addition to installing 4 megawatt of WHRS and first floating solar power plant of 4 megawatt, we have again taken many operating initiatives to optimize cost and improve the plant throughput. In regard to JP acquisition, one of the initiatives which we took is how to enroll the existing dealers of JP, as well also to introduce brands well in advance in central regions where we are not present. I'm happy to share that our initiative has led to enrolling around 1,000 dealers of JP, which would, in time to come, would be very helpful in ramping up our capacity of selling more cement. In addition to this, we have been also able to operate with the support of JP group, the plants which have been able to deliver the cement required. Now, for rest of the details and key financial updates, I would now request our CFO, Sri Dharmendra, to share with you the figures and facts, and thereafter, I'll be very happy to answer all questions in the Q&A. Thanks and all the best.
Thank you, Singhi. Good afternoon, all. As all the major business updates have already been covered by Puneet and Singhi, I'll quickly jump into the key financial updates. With regard to the incentives, this quarter we have accrued rupees 92 crores of incentives, which takes the FY23 accrual number to about 272 crores. The collections during the quarter has been rupees 96 crores, and the total collection for the year has been close to 250 crores. The average receivable as of 31st March stood at 700 crores. Going forward, including Murli, we expect incentive accruals to be around 275 to 300 crores for FY24. Regarding other expenses, essentially we have seen an increase which has three large components. The marketing spends during the quarter increased by about 35 crores, and also around 20 crore each is on account of increase in the packing cost and depot expenses because of the higher volumes. On the debt side, on full year basis, our gross debt has increased by 623 crores, and the closing debt as of 31st March stood at 3,763 crores. The net debt to EBITDA as of 31st March was 0.29 times. Regarding capex, we have spent close to 27 crores during the full financial year FY23. As mentioned by Singhi, we have closed this year with the capacity of about 38.6 million tons per annum, and the capacity as on date when we are talking today stands at 41.1 million tons. Our budgeted capex spent for FY24 is in the range of 5,000 to 5,500 crores, including the payment which is to be made to JP for the new acquisition in central region. Of this, roughly about 3,000 to 3,500 crores will be paid for the acquisition, and balance 2 to 2.5 thousand crores will be for the ongoing expansion projects, plus the other efficiency, land, maintenance, capex, etc. And pursuant to aim of becoming a pure play cement player, and as already informed you earlier, the company had entered into a binding agreement to sell its entire investment of 1.8 crore equity shares of Dalmia Bharat Limited at a consideration of 800 crores to Mr. Sarvpriya Healthcare Solutions Private Limited, a promoter group company. With regard to the same, I would like to update that the total receivable, out of the total receivable, 20%, which is 160 crores, has been received in cash, and for the balance, 80% consideration, NCDs have been allotted to DCPL. And also in line with the capital allocation framework, the board has proposed a final dividend of rupees 5 per share, which is subject to the approval of the shareholders in the ensuing AGM. This is in addition to the interim dividend of rupees 4 per share, which was paid out in the month of November. The total dividend declared for the year, including interim, is rupees 9 per share, which is same as declared and paid in last year. With this, I now open the floor for question answer. Thank you very much.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Indrajit from CLSA. Please go ahead.
Hi, good afternoon. Thank you for the opportunity. I have two questions. First, on the organic expansion, while we have deferred the Bihar grinding unit, the other south grinding units remain as is. So if you can help us understand what is the status of land acquisition, ordering of equipment, etc., and if we are confident of commissioning it by FY24.
Yes. So first expansion of our cement capacity is going to happen by June end this year, which is near Tuticorin, which we call Satur area. So this will get completed well before time by June 23. Second, two cement units which are being set up now in Kadapa and Ariyarur, they are all expected to go by March 24. So this is basically the 4 million tons. This will get added to the capacity in addition to some debottlenecking projects. So we are all on track and well within the cost.
So what is the remaining capex in the organic part now?
Now in totality, we will be investing about 5,000 crores, which would also include the capex for JP assets.
No, that is just saying for FY24. I'm saying what is the pending capex just for the organic? So after what we have spent, say about 2,500 crore for organic, will there be still some pending capex for the organic part?
Yes.
So, Indrajit, we will not give a breakup between how much is inorganic, for that officer. We are looking at spending about 5,500 odd crores next year, including JP acquisition. JP, depending on, how each of the transactions is approved by the bank and the lenders. But we are looking at a range of between 5,000, 5,500, 5,700 in the range right now.
Sure. Thank you. My second question is on JP acquisition. So we understand that you have signed a definitive agreement and we had signed one earlier for the standalone JP assets. So what kind of timelines we can look at when those assets will be under our fold?
It is in the process and now lenders are taking up this matter and within a couple of months we should be able to operationalize. And
we will need NCLT approval for these or that is not required?
May not be required.
No, see, Indrajit, Rajiv here. See, this was not admitted by NCLT, so the NCLT approval is not required. This requires lenders' approval, and only for the Super Dala, there are certain conditions precedent. So there are two parts of it. One is the lenders' approval, second is the conditions precedent which is to be met. But as Singh was saying, at least the tranche 1 and tranche 2 that we are speaking about, we hope to close that in the next couple of months. And the Super Dala, the condition precedent will be the closure of arbitration proceedings with Ultratech. And once that is done, it's only when this will be closed.
Sure. Thank you. I have more questions. I'll join back.
Thank you.
Thank you. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Good afternoon and thanks for the opportunity. My first question is on the cost. So there was a sharp increase in raw material cost. Is it largely because of high opening cost inventory or also some other line items like fly ash slag also saw some inflation? If you could share some details there. And also the second part is on the fuel cost. If you could share what is the coal cost in 4Q and what is the guidance for 1Q?
Yes. So one, to some extent, the raw material cost has gone up on account of inventory. And second, since our CC ratio has also gone up, so to that extent, raw material cost has gone up. And thirdly, there has been little price increase in fly ash and slag. So in totality, that is the reason. But at the same time, there has been substantial reduction in fuel price, power and fuel costs. And this will be again further visible in quarters to come.
Okay. Is it possible to get some quantification at least on the power and fuel cost, say in terms of dollar per ton, what was the average in 4Q and what's the current procurement levels?
So for the quarter 4, both the purchase and consumption has happened at about $174, $175 per ton. And during quarter 1, we believe the rate should be anywhere about $165 per ton. So another $10 is what you can see. The spot rate which Mr. Singh had spoken about, the impact of that you can see quarter 2 onwards.
Understood. That's very clear. And one just last question. We are doing a great job on increasing the blending ratio. I heard, if correctly, it was 84% in FY23. So just want to know what sort of near-term target are we looking for in FY24-25? And if some comments on the acceptance of blended cement in non-trade segment, please.
Yes. So let me answer the last question first. You are fully aware of the commitment of Indian government to go green by 2070 in totality, but at the same time, the various initiatives which government has taken to encourage green products, whether it's green cement or green steel or many other such products. So now, various government departments have started accepting PPC or PSC in place of OPC, and our team has been working very efficiently on this, and we are proud to say that in many projects, including the projects for tunnel, projects for road, projects for bridges, now Dalmia Infra Cement, which is a PPC product, has been approved in place of OPC, and that would help us in a big way. Similarly, there has been now awareness in builders and the road contractors, so they have also started now accepting PPC, and there has also been force from NHI also to go for more and more PPCs. So this is one part. Secondly, in quarter to quarter, our blending ratio will go up, as we are fully committed that in few years' time we should be producing only blended cement, which is low carbon cement.
So from 84%, any sort of target we are looking at internally for FY24-25?
Internally, yes, but then we will share when we do it.
Rajiv here. We don't want to put a number on a yearly basis or quarterly basis. I think our goal post is very clear. We just said we want to be 100% ready. We've been saying that for a couple of years now, and I think the roadmap and trajectory is very clear. We have been increasing it year by year. The thing is, it's very difficult to put a number on a quarter or a year because every market operates differently, right? And so we'll have to keep looking at it and tweaking it and recalibrating it. So at this point of time, the goal is very clear. I think we have been showing continuous improvement, and that journey will continue.
And I may also add that even on total all India basis also, the low carbon cement percentage in India is going up, and this is the highest percentage of low carbon cement in the world. So it may be today around 71-72%.
Got it. Thanks, Rajiv, and thanks, Ingi. All the best.
Thank you.
Thank you. The next question is from the line of Pinakin Parekh from JP Morgan. Please go ahead.
Thank you. So I have two sets of questions. The first is on the JPA Cement acquisition. Now, given that JPA, the parent entity, is in the IBC and timelines, the sanctity of timelines on any resolution over there has in the past across the board not been respected. Is it fair to say that till Dalmia has clarity on the JPA acquisition, it will not go ahead with any organic expansion plans beyond the 46.6 million tons?
Let me first clarify that JP asset was not admitted in IBC. And secondly, now even in court also where the petition was put up, now even banks are also now requesting High Court that since resolution is happening, so they would not like to proceed ahead. And because of that reason, we are fully confident that in couple of months we will be able to get this acquisition in place.
Agree, but if it gets delayed beyond couple of months, should we? So I'm just trying to understand that the next phase of organic expansion beyond 46.6 million tons. When should we see visibility on that? It's only after JPA gets done, whatever the time frame would be, or during FY24 we can see that.
No, so Rajiv here. Let me answer that question. See, we have guided everyone to 75 million ton by FY27. That plan and that goal is intact. What we have done is 49 million ton is what we committed by FY24. We're likely to go at 56 million ton, including JP acquisition. we are absolutely confident about JP acquisition being closed in the next couple of months. In the next couple of months, hopefully the next quarter, we'll start giving you roadmap for the next leg of expansion from 49 or 56 to 75. So there is nothing being stopped pending JP. I think we are committed to building a 110 to 130 million ton company by FY21, and we made a milestone of 10 million ton by FY27 stands.
Sure. Secondly, just trying to understand the final cost of the JP acquisitions. So the company mentioned that 5,000 crores of spending in FY24. It includes 2,700 crores of organic capex. The rest is JPA. So is this the final cost to ramp up the assets, or will there be an additional cost over the 2,500 crores? What will be the total cost for the 9.4 million tons? Given now that you have signed a definitive agreement, you will be in a better position to answer that.
So, if you remember when we made the announcement about the JP acquisition, we had said the total consideration is about 5,666 crores, and we had also said that we'll probably spend about 800 to 1,000 crores additional to bring the plants to the state of the art, like to operate, including WHRS, solar, and everything else. Now, only the third tranche of Super Dala is likely to probably, it will be dependent on the closure of the arbitration proceedings between JP and Ultratech. Other than that, if you look at the balance amount, again, we'll be spending roughly about 700 odd plus crores on bringing that. So the total cost would still be about $70 odd per ton. I think it's a great asset, and as you were saying, we also started the tolling agreement. We have started enrolling dealers. We have started understanding the market. We have started building the brand, so that the moment these transactions are closed, we can hit the road running.
So it's fair to say that there will be another equally large amount of spending related to JP and FY25 as well, right? Beyond the 2,500 crores this year?
Oh, absolutely. We had already guided them when we acquired, talking about a number of 800,000 crores on the overall JP acquisition.
Understood. And my second question, just trying to understand the power and fuel costs. So $175 in 4Q, $165 in third quarter, $140 per ton at the spot market. So to that extent, at this point of time, the power and fuel decline so far did not flow through to the EBITDA line. Going forward, at least in the first half of the year, do we expect pricing to hold up and hence the full benefit of lower power and fuel cost to flow through the bottom line, or pricing is expected to remain soft?
Difficult to predict pricing. As you know, there are too many moving parts in the pricing, the region, state, individual markets. But I would not like to look at pricing on a quarter-to-quarter basis. If you look at on annual basis, I think we've been getting around 1.5% to 2.5% increase on an average. Last year, we've seen 4% price increase. So, power and fuel costs had gone up dramatically. As we all know, we keep certain stocks. There are certain stock prices what Charity and Mr. P. shared a few minutes back. So definitely our ability to purchase power and fuel at petcoke at lower cost will flow into the EBITDA. How much we decide to invest back? We are building a business for generations. We're building a business for decades. So there is certain investments in different markets in terms of brand. As we're becoming a larger company and a large company, we also need to spend money on brand. We're getting in newer markets. So we'll have to balance this out, right? We would like to build a sustainable and scalable business model. For that, we may have to invest certain amounts of money. But yes, the petcoke price coming down is a huge boost for us to invest money in the market, in build our businesses and build a sustainable and scalable business.
And let me just add that yes, whatever you are thinking, power and fuel cost will come down in quarter one and quarter two also.
Understood. Thank you very much, sir.
Thank you. The next question is from the line of Prateek Kumar from Jefferies. Please go ahead.
Yeah, sir. My first question is on the fuel costs again. So has this inventory impact not been there? So what would be the power and fuel cost benefit which we could have realized on a per ton basis during the quarter?
So every $10 change, Prateek, in terms of pricing leads to about $35 of cost savings. To that extent, it has flowed in. What we've also seen during the quarter that our renewable power capacity has gone up on consumption basis. That has also led to some benefits. Like Mr. Singhi had mentioned in his opening remarks, in the last quarter 3 and quarter 4. There has been a little bit of an anomaly because of the opening and closing stock. Otherwise, as the markets are seeing the benefit and the industry is witnessing that a decline in power and fuel cost flows into the numbers, it does into our numbers as well. And on a year basis, the inventory impact is actually almost negligible. So going forward, since this will normalize, you will see that next quarter, to the extent of softness in the power and fuel cost, it will directly flow into the P&L.
Right.
I think Pinakin was also asking.
Right. Okay, so on a closing FOCI basis in terms of power and fuel cost, I mean, assuming petcoke remains at $140 or lower, so on a full year basis, FY24, some lack of renewable power as well.
Mr. Kumar, the audio is not clear from your line, sir. The audio is breaking. Please.
Hello. Is it better now?
Yes, sir. So please repeat. The current participant has left the question queue. We'll move on to the next question. From the line of Rajesh Kumar Ravi from HDFC Securities.
Yeah, hi sir. Good afternoon. Am I audible?
Yes.
Yes, you're audible.
Yeah, hi. Our first question pertains to the fuel cost. Could you give us on per kilocal what was the costing in Q4 and what is the expected, what is the current trend in Q1? And secondly, pertaining to the same, if what you have mentioned that the blending ratio has increased to 88%. It was close to 83%. So significant savings should have come in even from your raw materials.
Mr. Ravi, please use the handset mode, sir. The audio is...
Hold on, please. Hello, is this better?
Yes, sir. Thank you.
Okay, so on a per kilocal basis, the fuel cost would have come down. So what is the per kilocal cost? And with the increase in blending ratio from 83 to 88%, even the total variable cost should have come down. But as you have reported, even the variable cost has gone up Q on Q. So what explains that?
So the kcal rate for the quarter is 2.06. And on the raw material, Rajesh, I think what everybody is doing while calculating the VC is taking the full impact of the change in stock of inventory. And which is why you are seeing an increasing trend on a quarter-on-quarter basis.
Mm-hmm.
But if we were to remove the impact of the opening high-cost inventory, the decline in raw material or power fuel is visible, and more so because the blending has definitely gone up between quarter 3 and quarter 4 from 83 to 88%. But I think it is only because we have high stock of opening inventory, which is at a higher cost, also has certain fixed expenses allocated into it. It is showing an increasing trend when you club all 4 line items and do a VC per ton. I think next quarter onwards you'll get a lot more clarity as this inventory line normalizes. And but if you were to ask X of this, the benefit is visible in the raw material and power and fuel cost respectively.
Great. So from 243 in Q3, we have already come down to 2.06 sort of, and there you are further expecting it to come off in Q1. So, and that with the increased blending and no anomaly on the inventory side, we should see boost to the numbers, assuming prices remain stable on the cement side, right?
Yeah, Rajesh, look at the inventory line. You look at it on a year-on-year basis, there's actually no impact. On a quarterly basis, you do see impact of opening stock and closing stock depending on production which shut down. We also did some debottlenecking because we had to take shutdowns in some of our plants. So, this is a quarterly anomaly which keeps happening depending on when there's so much of volatility in the input cost. The opening stock or the closing stock valuations will be very different. Right, so I think if you look at an annual basis, I think generally you see over the year the trend of opening stock and closing stock does not really make an impact. So I think I just want to make that point that yes, on a quarterly basis you will see aberrations here and there depending on schedules and everything else, but on an annual basis you don't see that kind of impact.
And sir, for full year, what would be your per kilocal costing?
Full year will be 2.21.
2.21 and closing is 2.06, so a good saving higher on. Okay, second on the acquisitions and capex. First round JP's acquisitions which was announced was 3,200 crore, right? And the current announcement which came, which would another sum up to another 2,500 crore. Is that understanding right?
Yes, absolutely.
And additionally, we would be doing another 1,100 and 800 crore additional. You said 1,800 crore is total? to make them ship safe?
800.
We say
Total.
for the entire
9.4.
9.4 million tons, we may spend between 800 to 1,000 crores.
Okay. So this 5,500, 5,600 total acquisition cost will go in FY24 itself?
No, it will happen over the additional 800 to 1,000 crores will be spread, depending on when each of these plants and the tranches are closed. As India was saying, it may take a couple of months. So the initial money concession which we need to pay to JP and the banks will happen immediately in FY24. The expansion that we're talking about, or the modifications and refurbishment and everything else, would generally happen in the subsequent year. Even if you look at on the 5,666 crores of consideration, the JP Super, which is the separate tank 3, would happen only when that is closed, which is subject to the condition that we're speaking about of Ultratech and arbitration with Ultratech and JP, and that consideration is 1,690. So out of 5,666, we take out 1,690. We're talking about a total of about 4,000 odd crores. And on 4,000 crores, we'll probably spend about 800,000 crores more, which is a total consideration of 4,800 to 5,000 crores for its 9.4 million ton of capacity.
Thank you. Mr. Ravi, may we request that you return to the question queue for follow-up questions. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to one per participant. Should you have a follow-up question, we would request you to rejoin the question queue. The first question is from the line of Shyam from Franklin Templeton. Please go ahead.
Hi, good afternoon. Thanks for taking my question. Hope I'm audible.
Yes.
On the geography mix perspective, we do hear that southern region was particularly quite strong in the fourth quarter. How has the geography mix changed when we look at sequentially, and was that did that have any impact on the EBITDA per ton or the spread that we saw on a quarter-on-quarter basis? That's the first part of my question.
Geographically, it has not much changed, but at the same time, when we look at increase in prices, then in East, prices had gone up to some extent, whereas in the southern part of India, prices either were stable in one or two states and had gone down also. So from mix point of view, not much change, but from pricing point of view, it has changed, and that has got us some price increase.
Sure. Understood, sir. And sir, just to follow up on this, now given that we are seeing southern pricing weaker, now with the cost curve shifting down meaningfully from the second quarter F24, do we see sharing some of these benefits with the customers until we reach a certain hurdle rate of EBITDA per ton? How do we think about the sharing of these cost benefits that we likely see in the second half of F24?
Hi, Rajiv here. When the input cost went up so much, the question came to us was, why you're not able to share it with the customers, and why you're not able to pass it on to consumers. And when the input costs started coming down, the question is, how much of it will be shared with the consumers? I think, there will be volatility in the prices. As I told you, there are multiple factors that define how the prices move by regions, by state, by different product lines. On an average, if you look at it, our prices do increase year on year, between 1.5% to 2.5%. Last year was 4%. In spite of all this stuff, people had concerns about the entry of Adani into the sector, what will happen to the pricing environment, other things. And if you look at it, on average, we got about 4% price increase. Right? The demand environment was very, very good last year. As you were saying, we saw almost 9 to 10% cement demand, for the industry as a whole last year. And we expect that to continue in next year as a pre-election year. Now, with such a great demand that we're talking about for the industry, I would expect, with the input costs going down, I would expect the pricing performance to be stable, and I would also expect the EBITDA performance to be better for everybody. I'm not about us specifically, but for the industry as a whole, I think.
I was trying to get it from an industry perspective as well. So thank you. And one last point from an expansion per se, in F24, our southern cement grinding capacity goes up by roughly 4.9 million ton, including the debottlenecking in Belgaum. How do we, I'm trying to understand, so from supplying of clinker to these units, how does that arrangement work, sir, if you can just help us understand that?
So that arrangement works very well because we have sufficient clinker to support this production of cement. And as you also know that once we put up a capacity of 4 million plus, immediately we would not be working on 100%. But at the same time, the maths which we have done, the blending ratio which we have done, we have sufficient clinker to serve full capacity of cement in southern India.
Clinker devoted.
Sorry, just to clarify, this is from the Kadapa unit and existing in Ariyalur clinker that will support this, just to understand.
Yes. So we have 4 plants in southern India which produces clinker, which is Dalmia Bharat in Ariyalur in Trichy district, then Kadapa in Andhra, and then Belgaum in Karnataka. So these all 4 plants produce clinker and cement. So all these clinker of these 4 plants will be able to serve the cement capacity which we are putting up.
If I can just add here, when Sandeep is opening remarks spoke about the clinker debottlenecking and, how we're going to increase in the next financial year, almost, I think, 0.9 to 1 million tons is coming from south. So there is almost a 0.9 to 1 million ton of clinker debottlenecking which is happening in south, and in addition to what Sandeep was talking about, Kadapa. So I think we are pretty comfortable about that. We don't see a concern. As Sandeep also said, increasing our blending in south in a big way. I think it's very encouraging result, and we hope to continue with that.
And another 1.2 million ton capacity of clinker would also be added through debottlenecking.
Understood. Thank you. Thank you very much. I'll fall back in the queue. Best wishes.
Thank you.
Thank you.
The next question is from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
So thank you for taking my question. So continuing with what Shyam was asking, if we look at bulk of our expansion next year is happening in South India. In light of that, how do we expect blending ratios to go up? I mean, our understanding was that acceptability of blended cement in South is still not as high as it is in East. So if you could highlight, what is the strategy there?
So I would say that there were apprehension in the mind of many people 2 years back, 3 years back, and little bit in our mind also. But then whatever performance we could see, whatever the success we could see of last 1 year, we do see that there is a full acceptability. And second, there is 100% blended cement usage in retail market trade sale, and our trade sale is going up there. In addition to this, in institutional sales also, more and more acceptability has been coming, which I shared earlier also, that the government is also working on it. The prudent developers, prudent contractors, they are now also accepting PPC. So this is the trend which will ultimately prevail.
Pulkit, if I were to just add a few numbers to it, I think in FY19, 5 years back, our blending in South was almost 40-45%. It increased to 50% in FY21, and on a full year, FY23, 65. Q4, the blended cement percentage was highest ever at about 75%. So I think as Mr. Singhi was saying, when there is an effort on both the side of the government and the companies all together in the sector, I don't think there's problem in terms of acceptability, and it's actually showing up in the numbers also now. Year on year, it is getting accepted. 75% for South is actually pretty high.
And if required at any point of time, our team can share that how acceptance of PPC has come up in various very important critical projects of the country.
Sure, sir. So that's helpful. So one more question, if I could. Can you split the volume growth between South and East? Maybe for the quarter or for the year?
Pulkit, we don't give regional numbers. I'm sorry about it. I think you said we have seen double-digit volume growth in every region that we operate, and I think we want a very, very stable growth in every region. Unfortunately, we don't share numbers that high.
No problem. Thank you so much, Rajiv.
Thank you. The next question is from the line of Pritesh Shah from Investec Capital. Please go ahead.
Yeah, hi. So a couple of questions. First is with respect to the JP assets, can you please give some color on limestone reserve, that's one. Second is the growth optionality on the assets, and third is incentives, if any, related to the assets we can enjoy going forward. So that's the first question in three parts, sir.
There is sufficient quantum of limestone in the lease area, and we have done some study, and more study would be done as well. You can also be confident of Dalmia's history of getting limestone everywhere, whether it's a Kalyanpur, whether it's a Morley or any other. We have seen JP area, and there is sufficient limestone, and this is how we have gone ahead. So this is on limestone part. Yes,
second question over here was growth optionality. Can we increase the capacities over here? And the third question over here was on the incentives, if any, corresponding to the JP assets.
So now, are you confident of limestone availability? Then I can talk of expansion.
Yes, sir. I'll go by what you say, sir.
Thank you. Yes, once we acquire this asset, then definitely we will come out. But then definitely there are possibilities. There are good possibilities. One, on account of good plant of JP, as well as the possibilities, limestone reserve, as well as the increasing demand in central region, and particularly to some extent in part of north also.
Sir, possible to quantify something like we can double the cement capacity, double the clinker capacity? Any numbers over here?
What do you want to hear?
Whatever is feasible.
So Ritesh, as I said earlier, we would share the plans beyond 64, 56 to 75, hopefully in the next earnings call. We'll have to unfortunately wait till then. Once we are closing the JP acquisition, we don't have opportunity in central region. We have put our minds there. We are looking at each of the plants, the development opportunities, expansions that we can do further. But these are all work in progress, and I would not want to jump into it and commit some numbers. I think we'll have to do our homework properly and then come to you and report the numbers. So I think wait for another 3 months. Hopefully, we should be able to announce in the next earnings call.
Right.
There are good growth opportunities everywhere.
Right. Sir, just last question. What is the status of East India Energy? I think this 180 megawatt. Is it also part of the transaction? That's one. And the second question over here is basically how critical is Super Dalla to us? And the value that you have indicated of 5,600 crores, does it include or exclude that? If it excludes, what's the quantum corresponding to that particular asset? Thanks.
I'll answer the last question first. 5,666 crores that we spoke about includes a value for Super Dalla 1,690 crores. Right, so that is inclusive. 1,690 without that is about 4,000 crores.
And this power plant is part of the deal.
Power plant is part of the deal. Sure. I'll join back, Jackie. Thank you so much for the answers.
Thank you.
Thank you. Ladies and gentlemen, due to paucity of time, we will take the last question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah, thank you. Sir, first on the costing front, just to clarify, the other expenses that we mentioned, 75 odd crore higher. So from the Q1 FY24, will this number will remain so that in totality or in per ton in terms of the other expenses, will it remain same, or can we see a sizable reduction there?
So as Narinder had mentioned, the sequential 80 crore increase that you've seen in the other expenses, 40 crores which pertains to the bags and the depot expenses is semi-variable nature, so it depends upon the volume. And the 35 crores that we had spoken about pertains to advertisement expenses because we are adding capacity. On a per ton basis, the costs have been relatively stable. So going forward also, I think on a per ton basis, we should expect stability. It is this sequential increase that you saw was mainly to do with an increased volume. So I think on a per ton basis, the costs are expected to remain stable at the current levels.
And otherwise also, if you look at fixed cost per ton, you would find that Dalmia Cement's fixed cost per ton would be one of the lowest in the industry.
Yes, sir. Secondly, on the KKL basis, we mentioned that for 4Q it is 2.06. So in Q1, this current quarter, how much we are expecting the KKL
About 5% reduction we can expect, 5 to 6%.
Okay, 5 to 6%. And net, if we look at the, let's say if we assume this $165 at coke, on the full year basis, if we have to look at, how much more reduction? Sorry?
That will go down further. So let's say Q2, you can expect fall of about 10% as the prices have come down. So Q2 improvement of 10% over Q1, and Q1 itself will be improvement of 5% or 6% improvement over Q4 of this year.
Okay. That's great.
If the prices move, it will move.
Okay.
Thanks, everyone.
Yeah, sir, the last one, sir. Have you seen any price increase in this month, April?
We wanted to see, but we couldn't see.
Okay. Thank you, sir.
Thanks.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Puneet Kalra for closing comments.
Thank you all for your interest in us, and we ended a very volatile year with great performance. I look forward to staying in touch, and I'm very confident that there are good times ahead. Thank you.
Thanks, everyone.
Thank you, sir. Ladies and gentlemen, on behalf of Dalmia Bharat Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.